Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Pavitra Parekh and Mangala Malu. Good morning, guys.
Good morning.
Another quiet session, right? The markets opened up at higher levels, record levels. From there, we've slipped a bit as we speak. Absolutely flat on the benchmark indices. We've been climbing higher for the last 6 trading sessions, and today there is a bit of a pause. There are important cues that the markets are tracking. The Q2 GDP data for India out at 5:30. The MSCI rebalancing, which gets effective from today. So the adjustment will take place today post-close. So volume should be on the higher side. And of course, as we've been saying, the highly anticipated speech from Jerome Powell. Things have been quiet, sluggish across the rest of the global markets as well. But this week truly belongs to Reliance Industries. Reliance Industries today as well has seen a recovery on an intraday basis. Pull that stock up. It's now up close to about 0.5%. And in the last 3 trading sessions, that's including today, while the Nifty, the mid-cap index, it's up close to about 0.5%. Reliance Industries is up more than 4%. So that is single-handedly contributing to the up move that we've seen in our own markets. At the same time, banks as well as IT have taken a bit of a breather. Hi, guys.
Hi. Hi, good morning. So, like you said, it is a bit of a quiet day, but within that space, it is really the metal space, which once again, after yesterday, is holding up quite well. We have the auto sales figures, which will start coming in tomorrow. So, that entire space is in focus as well. Those stocks are also doing quite well. On the downside, it is banks and tech. And, we're also watching what's going on in China, because there are expectations that their strict zero COVID policy will be loosened a little bit. They did announce some infra and property related reforms, which also have the markets excited. So we're, watching what's going on that front as well, and of course what that could then mean for crude prices. But so I mean, there is a lot for us to track, but today, Mangalam, it's quite quiet after hitting record highs once again.
Yes, after hitting record highs once again, but it's good, right? A lot of times quiet is nice, and that's primarily because once it's quiet, people can actually calm down, look at the stocks that they're interested in buying, etc., and go ahead and make a decision. But what's interesting is that the mid-cap index is outperforming today. Let's see where it goes from the highs of this morning, though. We're off on that index as well. But let's talk about the big mover, Gland Pharma. That's the stock in focus as the company has entered into an agreement to acquire CDMO player Sensex Group for about 120 million euros. Ekta caught up with Srinivas Sadhu, who's the MD and CEO of the company, and spoke about the sales guidance for the Sensex Group going forward. Well, the pharmaceutical names do that to your tongue. You listen in.
If you look at the history of Sensex, right, when they've acquired the Roche site, it started off mostly with the ampule business. Then over a period of time, they acquired other assets. So they're not completely leveraged from the business perspective, the other sides. And they're moving towards a low margin ampule business to the higher margin, pre-filled syringe lyophilization, the needleless injectors, the ophthalmic gel, sterile products. So they're moving towards this. A lot of projects are in place in the last 18 months. And that's one of the reasons you see the development services revenue has gone up to 25 million euros. So the shift from ampule business to the other side of the business is happening today. So I think that's why it looks flattish, but actually the revenue has moved from a certain low value items to the higher value. So the margin profile is increasing. So I would say, there's a lot of scope to increase the revenue as well as profitability in the near future.
Okay. The other bigger concern, rather, revenues, yes, but margins for the company. Just to give you some statistics, and I'm sure you know them already, CY21 margins were 13%. CY20 margins were 11%. First half margins were 19%. And historically, Gland has had higher margins. You came down to 28% in the previous quarter, but it's always been above 30% historically. Why are the margins so low for Sensex, and what does it do to your blended margins?
I think I'll go back to what I just said. When they started off, most of the revenue was coming from ampule, which is a low margin business, which they're moving out. They acquired a couple of sites in the last few years. In 2007, they acquired another site where they have installed capacities. And if you look at capacity utilization of these sites are pretty low in some of the lines. And that's where the process is happening today, and the revenue start building up. And as you know, in injectables, 80-85% of fixed costs. After a threshold, whatever you actually increase in the revenue, actually most of it flows down to the EBITDA. And we're pretty confident that the more utilization of the other sites which they have come into existence in the last couple of years, the margins will flow down and we will see a better margin profile. And this we're talking about standalone as a Sensex. Now, with Gland coming in, there are several synergies which we can work on, which will improve the margins, to where we are in next couple of years.
Can we assume that margins will probably come down on a blended basis, say to a range of 25 to 30% initially?
In the near term, it could be dilutive in terms of margin, probably, for the first year. But like I said, we are looking at a long-term driver, maybe 12, 18 months down the line. Once, the most of the projects which are ongoing at this standalone company starts kicking in, the margin improvement you'll see. And also, once the synergies of Gland and Sensex come together, the improvement will be more.
Okay, are you in a position to provide FY23 guidance now, because you had withdrawn it based on factors such as cost inflation? Are you in a better position now?
I think we still need some more time. I think you're aware of the situation better. Still, a lot of different dynamics at the marketplace. We're seeing a lot of companies pruning down products. Some companies are, getting sold. So we're just wait and watch kind of situation. So I'll just still a little bit more time to come back to you on a solid forecast.
Well, Mr. Sadhu, obviously the big worry is the fact that the stock is down over 50% from its 52-week high. You all have been struggling in terms of sales, at least in the past couple of quarters. Margins have come down to 28% versus your historical over 35% in some quarters as well. Can you guide investors where business is in terms of the near-term challenges that you have faced? One, in terms of competition in the US, two, in terms of declining COVID-19 sales, and three, in terms of the overall supply issues that you have been facing?
While I can't comment on the market dynamics and the movement of stock, from business perspective, yes, there are challenges in the US. The competition is higher. And because of a large base of COVID products, if you look at last year, as an injectable company, a lot of products of ours fall into that category. So there was a higher base last year, so we're comparing with that base. And added to the challenges we spoke about, supply chain and all that, it did impact our revenues and margins. And of course, the cost inflation in terms of logistics all went up. So that has impacted our performance a bit. Like I said, we are evaluating the business from a business perspective. More and more customers who, for the internal products are trying to transfer to our sites because of the cost pressures. That's how our model always helps. When there's a lot of pressure on margins at the front end, the companies whom we have relationship with, they try to move products to our sites, and that's what is happening today, and which we have anticipated, and that's the robustness of model. It's just that we need to give time to mull over this, and then from launches perspective, we are launching several products this quarter. From a filing perspective, we are on track on filing products, even the complex products we have filed. So from business perspective, from product perspective, we are there. It's just that the market dynamics is panning out a little differently, and it should settle down pretty soon.
With regards to Fosun Pharma and the stake that they hold in the company, 57% stake, their valuation has fallen 50% plus in just the past couple of months. Have they communicated any intention to pare down stake or a larger plan for Gland?
No, nothing been communicated to us. We've been hearing, like you've been hearing. So for us, it's business as usual. We're focusing on our business. We have to start building the future of the company, and that's where we are focused at. So there's no communication from our promoters now.
But you must be privy to what the parent company concerns are when it comes to their parent company, Fosun International, which has in fact been downgraded because of its over-leverage concerns. From that perspective, any kind of communication that you can share with us?
No, honestly, if you look at Fosun, it's a huge conglomerate. So we don't have interaction on a daily basis what they do at a Fosun International level. It's just not pharma. There are hundreds of companies under them. So we're just one arm under Fosun Pharma. Fosun Pharma themselves have more than 70, 80 companies. So we read news as you read. And we just talk about operational budgets and stuff like that, but nothing on this sort, and we don't have any official communication.
And there's no holdback in terms of capex as well as strategy and the overall plan for Gland in India.
Yeah. So everything is as per our plans. Whether investments or M&A, we have a clear roadmap. What we have laid down. When we went for IPO, we clearly said where are we looking at from inorganic perspective. what are the products we're getting into, and nothing changed, honestly. Other than the macro environment, we changed last 18 months. Nothing basically changed from the strategy perspective.
All right, that is the management of Gland Pharma saying that there's a lot of scope for revenues for Senexi to go up. They also see the margin improving because of higher utilization. But on, Fosun, they're saying they've not received any kind of communication from the management with respect to a stake sale. So that is an interesting chat. But with that, it's time for our first short break on the show. When we come back, we're going to shift focus to the world of commodities and tell you what's going on with Manisha Gupta.
Reimagineering brighter futures with smarter steels. ArcelorMittal, Nippon Steel India. Smarter steels, brighter futures.
सुन, इक्विटी में इन्वेस्ट कर, ग्रोथ का है चांस। सुन, डेट में है लो रिस्क, बात मेरी मान।
अरे बेटा सुन, गोल्ड सिर्फ गोल्ड, भैया ने भी यही किया।
सुन, अब तू कंफ्यूज मत कर यार।
अरे मतलब सुन, सबकी कर मल्टी
मतलब
मल्टी एसेट एलोकेशन फंड, यानी 3-in-1 फंड। ये इक्विटी, डेट, गोल्ड तीनों में एक साथ इन्वेस्ट करें। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेज ध्यान पूर्वक पढ़ें।
अरे भाभी जी, बड़े दिन बाद
मुझे बेस्ट डायमंड ज्वेलरी दिखाओ।
ये एक्सचेंज करा लूं?
बेटा एक्सचेंज में ज्यादा
नहीं, सिर्फ 5% कटेगा। पेश है 95% एक्सचेंज वैल्यू और 90% बायबैक भी। किसना डायमंड ज्वेलरी?
पुत्रवीर, कमाल दिखा अपना। कभी टेबल बन जाता है तो कभी अलमारी।
वीर MDF आम प्लाईवुड से ज्यादा मजबूत, ज्यादा किफायती, दिखे चकाचक, टिके टकाटक।
इस सुपरफास्ट जमाने में कार इंश्योरेंस क्लेम का स्ट्रेस क्यों? एक्को ऐप पे क्लेम सेटलमेंट सुपरफास्ट होता है।
Get super fast claim settlement. Acko, welcome change.
2 साल में रेट रॉकेट 100%।
क्या भाई साहब? Get सही price trends at 99acres.com. घर लेना हो या बेचना, एक्सपर्ट से ही पूछना। 99acres.com.
Uniparts India Limited now proposes an initial public offer of equity shares. The 100% book built offer is being offered at a price band of rupees 548 to rupees 577 per equity share. Offer opens on Wednesday, November 30, 2022. Offer closes on Friday, December 2, 2022. For risk factors and other details, please refer to the red herring prospectus, which is available on the websites of SEBI, the BRLMs and the stock exchanges.
Welcome back. From the mid-cap end of things, NBCC has been one stock which has been on a tear all through this month. It's up around 34% odd. Yesterday was higher in trade as well, and today as we speak it's moved to the high point with a gain of almost 5% odd. It recently won a few orders as well. Now the street is betting on some sort of execution and a turnaround, though it's way off its earlier highs, but currently seeing some traction. Similar can be said about GMR Infra, which is another stock which has done well all through this month and currently sitting at the high point of trade with similar kind of gains and incidentally similar kind of price as well. 42, 43 is where we are. But the focus is on the commodity space. As always, Manisha Gupta joins in, and today we're focusing on the metals pack. Manisha, we've seen a bit of a bounce there.
Well, he absolutely has. The last week was good, and when you look back at the month of November, all non-ferrous metals like copper, zinc, aluminum have put in gains anywhere between 7 to 8%. And when you talk about the non-ferrous metals, equal amount of gains is what we have seen come in for tin and nickel, up by nearly 17 to 24%. In case of ferrous metals as well, the iron ore prices are now trading at a 23-week highs, and we have seen prices gain up by 25% for the month of November. Though from the highs of 2022, that was a peak that we saw in the month of March, prices are down by nearly 36%. But with China has been easing restrictions on COVID, stimulus coming in, we've seen reserve repo rate also declined by 25 basis points there. All of that clearly seems to be supporting the metal prices there. Take a look at the steel rebar futures, and that one also is trading at nearly 1-month highs. We've seen the steel prices gain up by 6.5% for the month of November as well. And the precious metals are not too far away. Gold, by the way, is posting the the best monthly gain in the year 2022. We've seen gold prices gain up by nearly 7% for the month of November, with silver clearly outperforming with 11% of gains there. Markets do believe that December will start on a positive note as well, with the kind of fears that the street has in sense of inflation. Street is also looking out for the Jeremy Powell statement that happens today in the evening, and then you have the US non-farm payroll data coming in on Friday, so it promises to be an eventful rest of the week as well.
Manisha, thank you very much for that. Get into a break. On the other side, we'll discuss the auto sales. That's going to be the big domestic cue tomorrow. Numbers will trickle in tomorrow, but all the expectations lined up. Aniket Mhatre of HDFC Securities
are attempting a little bit of a move higher once again, so around 25 points higher on the Nifty. Now we have moved a little bit higher from that, the flat line where we started the show. It is the Nifty Bank which is still under pressure right now, seeing cuts of around 100 points. But let's talk about the auto sales now, because that is going to be the big cue that we have to watch out for. All of the sales figures are expected tomorrow, the 1st of December. So Mangalam, run us through everything that we should expect this time.
Well, a bunch of things. November, remember, was the post-festive season. So while sales are likely to be strong on the whole, the entry-level segment will still persist with some sort of weakness, and that is what is expected. The personal vehicle, passenger vehicle demand is largely unaffected by at the premium and the high-end segment, because those who want to buy cars out there have continuously gone ahead and bought those cars, and the waiting periods for SUVs have reduced, as well as chip shortage problems have eased too. So those are a bunch of things that will support demand this time around. Slight moderation, however, post-monsoon is seen in trucks as well as tractor sales, and two-wheeler retail sales, while they're still reasonable, wholesale has been affected by post-festive destocking. So all the showrooms, etc., have been destocking, and that will reflect in weaker wholesale sales that the companies will report. Urban, however, continues to be better than rural, and this is a trend that I'll be monitoring, not from an auto standpoint, but also the entire consumption basket standpoint too. So what does it mean in terms of overall numbers? The CNBC-TV18 poll suggests that Maruti will see total sales growth of almost 21%, 1.68 lakh units. A lot of this would be led by a lot of the new launches that the company made as well. For Tata Motors, we're likely to see a 19% jump, around 74,000 units of sales out there as well. For Ashok Leyland as well, a 30% jump on a feeble base, 13,600 units is what the company would sell. For M&M, the big kicker will come in from their passenger vehicles. A lot of their new launches have done extremely well out there, so that will show a 44% growth year-on-year, whereas tractor sales moderate, so a growth of just 1% year-on-year. And now quickly onto the two-wheelers then. Bajaj Auto total sales seen down 10%, and it would be a mix of both domestic sales as well as exports being lower. Eicher Motors would see Royal Enfield sales higher by about 43%, whereas TVS Motors will see total sales up by about 12%. For Hero MotoCorp, total sales seen higher by about 12% too. So apart from Bajaj Auto, most of the others are expected to show strong growth. Bajaj Auto is the only one which is expected to decline by 10% year-on-year.
Okay, thank you very much for that concise summary. To take the discussion forward, we are joined by Aniket Mhatre of HDFC Securities. Aniket, just to take the point that Mangalam made, on the passenger vehicle side, there is weakness at the entry level, and he also indicated the channel check suggests that the waiting period for SUVs has come down. Is this something that you are picking up as well? And what does it mean then for passenger vehicles? Nomura says it perhaps could result in OEMs bringing down their production or offering discounts. Is that the correct way to approach it?
Sure. Good morning, Rima. Thank you guys for having me on your show. So on the passenger vehicle side, clearly demand continues to be strong. You would have seen order backlogs continue to remain at a record high. Yes, with production going up, the waiting period is certainly coming off, but that does not mean that production will come down for OEMs, at least for the foreseeable future, given that they will have to first exhaust their waiting period, and then you will see productions come off. So over the next few months, we will see production continue to inch up for most of the OEMs as they continue to delve into their order backlog. So that's on the passenger vehicle. I think demand will continue to remain robust. Yes, we will have to continue to monitor the waiting period, which is coming off clearly because production is going up with chip shortage issues now behind us.
All right. Hi, Aniket. Good morning and thanks for joining us. This is Pavitra. You know, on the two-wheeler sales, the festive season is behind us. So how do you look at that panning out now? What is the kind of volumes that you expect? And in that context, then how would you look at the different players within the two-wheeler space?
Yeah. So as far as two-wheelers are concerned, clearly, even as Mangalam pointed out rightly, the premium segment continues to outperform related to the entry segment at the moment. For Royal Enfield, for instance, we are looking at a 45% volume growth in November. For TVS also, on the back of the launch of Raider and Ronin and Apache doing very well, we are expecting a 16% volume growth, both of them likely to outperform the peers. As far as entry level is concerned, Hero, we expect a 5% volume growth, and Bajaj we are expecting 5% decline because of a weak domestic outlook. If you look at overall going forward, right, there are some green shoots as far as rural indicators are concerned, with reservoir levels being very strong, and we expect Rabi sowing to be pretty healthy incrementally, right? So we think rural demand can come back positively from 4Q onwards, which would help improve two-wheeler demand in Q4. So even entry-level segment could improve from here on over a very low base of last few years in our.
Right. Aniket, you know, as far as the investment in auto stocks is concerned, I'd just like to know that December being a relatively lean period for car sales, etc., the stocks have moved already. How much is in the price? What are the triggers that you're looking at the next year? And to that extent, what is the stock that really stands out for you?
Sure. So as far as the auto sector is concerned, in auto OEMs, our top pick remains TVS Motors, given that it continues to gain market share in major categories. If you look at scooters, they have gained almost 500 basis points market share this fiscal to almost 24% now. Motorcycle market share for TVS has remained stable in the first half, but that's largely got to do with the production constraints that the company suffered in 1Q. Going forward, with the Raider ramping up and the Ronin also seeing decent momentum, I think TVS motorcycle market share should also inch up from here on. Add to that, even in electric vehicle space, they are doing the right numbers. I think they are talking about ramping up to 10,000 per month by December and going on to 20,000 per month by March. So they are ticking all the boxes for us, and hence TVS remains our top pick here. The second stock that we like in the OEM space is Mahindra & Mahindra. Here again, after having seen substantial market share loss over the last few years, I think M&M has clearly got its UV strategy right, and they are launching one blockbuster product after the other for the last few quarters. We are seeing a record high order backlog for M&M to the extent that some of its models are even on waiting of 6 to 12 months right now, which is very encouraging. Even the tractor cycle seems to be stable. We won't call it a robust cycle, but it's stable. We are expecting a single-digit volume growth this year and the next as well. So TVS and M&M are our top picks in auto OEMs at this moment.
What do you classify as luxury? Because we understand luxury is doing very well. So what is the classification? How much higher does the price have to be for it to be considered luxury?
So when you say luxury, typically in passenger vehicle, we look at Audis or BMWs of the world clearly. Up to that, below that, everything is, utility vehicles are classified below that, but luxury means largely Audis or BMW, which sell very less volumes in India. But yes, they are certainly doing very well at the moment.
And any channel checks on the luxury demand? Is it intact? Is it picking up? What is the waiting period like and discounting?
So to be honest, given that luxury segment, none of the OEMs are listed. We do not do channel checks on luxury segment per se, but at least from whatever we hear, we understand that the luxury demand continues to hold extremely strong. They are growing in double digit, and the demand continues to be pretty robust in the luxury category at the moment. That segment has been the least impacted post-COVID, and hence it's doing very well at the moment.
All right, Aniket, we got that. Thank you very much for joining us and taking us through all of the expectations from what the auto sales could look like, and also some of, how you are viewing some of the bigger players. With that, we are going to move on and get you a technical check on the market as well, which, by the way, right now is holding up with a gain of just around 15 points. So pretty much, still we've given up a bunch of the gains today, and it is a Nifty Bank, which is actually seeing losses go up. So it is currently 150 points lower on the Nifty Bank. That one is not seeing any kind of respite today. yesterday. So let's see and get you a technical check now. Mitesh Thakkar joins us from Earnings Wave. Mitesh, good morning. Thanks a lot for joining us. After hitting another record high, we have sort of, come down a bit. It is a little bit of a quiet day. Would you want to take any call on just the index level today?
On the index, we have talked about the fact that the market is slightly getting overbought, so not advising fresh longs. In fact, just trail your stop losses to about 18,550, 540 zone, that being supported, just below that. And I think as long as that is not being broken, just trade with more of stock-specific bias on the long side. If that gets broken, then I think we'll be aggressive in taking profits. But on the stock side, two stocks which look good to me are both from the metals pack today. Hindalco and Nalco. Disclaimer: we have some call option positions on Hindalco. It's given a good breakout. That's a buy. Keep a stop below 440 here. Look for targets of 465. While Nalco or National Aluminum, that's a buy as well. Keep a stop below levels of around 75.40, which is today's low, and the target on the upside would be about 79.5 to about 80 on the upside. Yeah.
Would you have a chart call on Oberoi Realty, Mitesh? Because the stock's seen a bit of a trending day so far, opened relatively flat, built onto those gains, and at any point one entered so far, they would have been sitting on some money at the high point for Oberoi Realty right now.
That's a stock, which in fact DLF and Oberoi both, I think, have given some kind of a trading breakout, Mangalam. The first target would be closer to about 950, 955 levels, because there's a historical pivot over there, but the chart pattern is very positive. And this breakout could see the stock head towards 1,020 odd levels. So stay positive over here. If somebody wants to buy, keep a stop below 919.
Thank you very much for joining about the markets and the way forward. Rohit Srivastava of IndiaCharts.com joins in now. Rohit, what's the call now? We've hit all-time high levels. We appear to be dithering at these at this juncture. What's the trading approach?
So from a trade perspective, we are seeing multiple signs to, expect some kind of a pullback in the market. What size and scale that will end up being is a bigger call. But at least in the near term, I think, there is room for us to shave off, several hundred points from here. Given that Nifty for the last 5 to 6 days is actually seeing substantially lower volumes than it has seen in the prior period, so that shows an exhaustion in the large caps that we are seeing. Of course, some of that trading has shifted to the mid cap. So I think, purely looking at levels at around 18,660 should be a key resistance level to watch, plus or minus a few points here and there. And my sense is from there, we do have at least near-term downside to say 18,400. But even if we break that, maybe even down to 17,800. So we're looking for some kind of, rollover. There are also, many other sentimental data points which actually add up to what we call as meaningful risk in the markets at this point of time. For example, the rollover that we saw from November to December was one of the largest in terms of points premium paid by, traders who are actually holding long positions. So this is at 160 points, 70 points. It's one of the highest. We've really not seen that kind of number. And at the same time, you're seeing close to now, yesterday's data shows 90,000 contracts plus long on the side of, foreign institutional investors, which is also over a 1-year high. I think June of 2021 is the last time we had a number close to 92,000 contracts. And so that kind of long position usually leads to a pause in the market. And I think that's the setup, multiple data points coming together. But I think the volume part is really meaningful because you have a higher price in Nifty and lower volumes, showing a volume divergence, which sort of is an exhaustion sign for the market in the days ahead.
What do you make of the volatility index, Rohit? Because, I haven't seen the VIX as low in the last 12 months or so. In fact, you could extend it all the way up to the pandemic period as well, where we saw that sharp spike in the VIX, and it sustained for about 18 to 24 months after cooling off in the manner that it has. Now we are close to fresh record highs. Tensions across the world are still there, but the VIX does not, signify that. I mean, we have the VIX at around 13 and a half levels. At times it has gone sub 12 as well. Do you think it's factoring in a fair amount of complacency?
Yes, I think that's one more addition to what we call a bunch of sentiment indicators, extreme long positions, rollover positions, and the VIX, which shows clear complacency. or the willing, we can measure, we can give it different names. We can say that people are not willing to pay too much for protection, so that's another way of looking at it, which means, people don't think they need protection, and so they're not paying a big premium for the option prices, and which is why the VIX has really come down so much. So this belief that, there's no risk, we are probably decoupled from what is happening around the world, is, I think, the risk on the table right now, because nothing has really changed as far as what is happening in the US is concerned. I think the short-term drop in the dollar post some of the recent comments did bring back some of the risk on trades around the world. But if we really look deeper into the earnings trajectory for US businesses over the next 1 to 2 quarters, it's going to be significantly to the downside, which is earnings are going to fall in the next 1 to 2 quarters. Even in our own case, we have seen flattening of earnings in this quarter, which is a start to, from the growth cycle that we had because of the push that we got during COVID. So I think there's this room, that we need to consolidate, correct, before we can move higher, because the whole trajectory of earnings, which had been spurred by the liquidity of, the post-pandemic period, is now, sort of coming to an end. And I think in our markets, that's not been deeply discounted in terms of, valuations. Most people want to believe that, this ride can go on, but a lot of the sectors that are doing well right now, say, for example, hospitality and so on, these are all the unlocked trades of the preceding period. I think that liquidity tightening impact on valuations is somewhat missing in the Indian markets, and that remains the ongoing risk.
So you're expecting a downside, a bit of a correction, but you don't see the Nifty going below 17,800, right? So that's about an 800-point drop from here on.
No, since the question you raised to me was short term, I don't want to really put levels below that right now.
Got it.
But what I is that the risk to more downside is definitely open. So we would not say that it gets to 17,800 and we should be buying over there. I think there could be more risk once things really turn over, because that's how market trends are.
Levels of 15,000 thereabout. Do you see the markets headed there?
I didn't get you.
No, I'm saying in June, the Nifty was closer to 15,000, right? 15,500. Do you see the Nifty headed there?
What I'm really saying is that the risk of it going there is still open. Okay. If we don't get there, say, for example, let me take the monthly bands. Earlier they were, sub 15,000. Now they've actually come above 15,000. So that's good news. On the monthly bands are somewhere around 15,500. That is sort of the 2 standard deviation move, which still is, within the closeness to 15,200 where we had reached. So we can't completely rule that out unless, the structure of something really changes in the structure in the macros. Till that happens, I think we can't rule that out.
All right. And Rohit, what would you think about the Nifty Bank? What is the kind of range that you expect for the Nifty Bank? And specifically within that, if you could take us through what you are seeing with just the PSU banks as well.
So my sense with the PSU banks is that they've probably peaked, and for the time being, I think it could be several weeks or months before you see new highs in that sector. And the reason is simple: we have seen peak optimism and volume in the sector. The volume is like 2-year, 3-year high, what you've really seen recently. And whenever you see price volume action that is that magnificent, you sort of come to the end of that particular trend for a while. So even if the upward trend in PSU banks has to continue, I think the case is that it's going to pull back and going to correct. So this would basically not be a right time to making fresh entries into PSU banks. In fact, might make great sense to actually book gains and then look for a better entry point later on. So that's my sense as far as PSU banks are concerned. For the Nifty, Bank Nifty, I'll give a similar range. Like on the upside, I would say the upper band around 43,500 is the upside, and the downside would be closer to around 41,000.
All right, Rohit, thank you for joining in and giving us your view. Though the next time we'd like to know, is if there's anything that you are positive on right now and something that one should go ahead and buy at these elevated levels as well. But all that and more for later. We take a short break, or... Okay, we don't take a short break. In fact, we have a new IPO opening. The IPO for Uniparts India, the company that operates in the agriculture and construction segment, has opened up for subscription today. The company has set the price band of the offer at 548 to 577 rupees per share. The implied market cap close to around 2,600 crore rupees. We have Gurdeep Soni, who's the chairman and managing director of Uniparts, joining in. Gurdeep, thank you so much for joining in, and good luck for your entry into the stock markets. The first question, of course, is with regards to the funds that you're raising. It's an entire offer for sale, so obviously no money is going into the company. What exactly is your annual capex? How do you plan to fund it? Is there any debt on your books? Just wanted to understand, going forward, how do you, fund your business needs?
Thank you. Thank you for having me on your show and giving me an opportunity to talk about my company. You are correct. This is a OFS completely, and primarily because the private equity investors in the company are exiting, and a small portion is also being exited by the promoters. The company per se does not need any fresh money. In fact, it's a very strong financial company. Just to give you some numbers, from the sales we had last year of 1,227 crores, our EBITDA was 271 crores, which was at a 22%. Our PAT was 167 crores, which was 14%. But and our ROCE is 31%, and our ROE is 26.8%. Fact is, I normally look at three figures: EBITDA 22% company, PAT 14% company, and free cash 7%. So after taking care of our capex and working capital requirements, the free cash is still 7%. In fact, the company has a stated policy of a 25% dividend, subject to approval of the board, and that may use 3.5% of the free cash, and the balance is still available for acquisitions moving forward. So acquiring more businesses overseas, So the company is very healthy. In fact, in the last 3 years and 3 months, the company has generated 424 crores of cash. Debt, which was about 4 years ago, was 250 crores. Is as we speak is almost about 60 crores. So clearly a very strong financial for this company, and Uniparts therefore doesn't need any fresh money for its own business.
Could you talk about your exports? Because about 47% of your revenues comes in from North America. Europe is about 25%, and everyone's concerned about a global slowdown. What's the outlook on exports?
Very frankly, as you mentioned, the two sectors that we are servicing, the construction machinery and the agricultural machinery sector. On the agricultural machinery sector, in fact, out of the top 10 companies in the world, all 10 are customers of Uniparts. And on the construction machine, out of the top 10, 5 are our customers. Specifically looking at the USA market, last year, the US government passed a $1 trillion infrastructure bill. And even though about 600 billion is going to be spent on things like the internet and the railways, but more than 400 billion is being spent on roads, ports, bridges, etc. So a lot of spend happening on the infrastructure side. Again, oil and gas companies are spending a lot of money on their infrastructure because they are so rich and making so much money. And what we are also seeing is that on the agricultural side also, because of the war, Ukraine and Russia, about 20 million tons of exportable grain from Ukraine went out of the market, and another 20 million from Russia because of embargoes. So clearly the food prices have gone up as well. In fact, Indian farmers started exporting, and then rightfully the government banned exports so that the food inflation doesn't happen in India. But in USA and Europe, the farmers have the maximum income they've had in the last 5 years. And really they're looking on spending to replace a lot of their equipment. The top company in the world in construction, who is my customer, is actually predicting that next year they will grow 13 to 15%. And they see the peak in this business only in 2026. Finally, on the agriculture side, again, the top company in the world, which is also my customer, they are predicting the peak to be 2025, and they too are looking at 12 to 15% growth for next year. So clearly, I would say both these segments are kind of recession-proof
All right.
as far as that is concerned.
Yeah. Gurdeep, you know the two main segments that you operate in, the 3-point linkage system that you have and also the machined parts. Can you take us through the margin that you make on both of these and the split right now?
So actually, the margins on both of them average are 22% EBITDA that we make. But it's a split, it's 18% on the agricultural machinery parts, the 3-point linkage, and about 25% on the precision machine parts, which are really articulation joints, which we make for the construction machinery segment.
Right. And the other thing that I wanted to know from you is that client concentration is a bit of a risk as well for you. You supply to John Deere, don't you?
Yes, sir.
How much is that as an overall proportion of your sales?
So John Deere last year was 33% of our business. But the next 5 customers that we have put together are another average about 5 to 7% each, you know.
So that makes 10 customers have over 77% of your revenues. That is a bit of a risk, ain't it?
To tell you the truth, all these are very large corporations. To tell you the truth, we haven't lost any customer ever. And to tell you the truth, we have a lot of customer stickiness. We have a model that is risk-free from the supply chain, which is really one of the bigger concerns because we have warehouses in USA and Europe, and we supply to all our major customers through the warehouses. Over 40% of our business is through the warehouses. And the customer stickiness, the fact that we are actually graded as key partners to most of these customers, we really don't see the risk of them moving away. But even having said that, we are constantly adding more and more business. I may like to tell you that the China Plus One that is playing out is also bringing a lot more business to our table. We are one of the real beneficiaries of the fact that a lot of American and European companies are very, very seriously moving their business out of China and coming to companies like Uniparts to really buy more and more from here.
So you make long-term plans, right? Your top customers on the agriculture as well as on the construction side indicated that things will peak out in 2025, 2026. That's what you indicated. What then?
Correct.
How are you planning to realign your business, or what's going to be the strategy?
Truly, you're talking about another 4 to 5 years when this happens. And you know, the world is in a constant flux at the moment. And really, what they had said would peak out in 23, 24 has become 25 and 26 only because of the geopolitical situations that has happened just over the last 6 months, you know. So, but clearly, there's a lot of demand. In fact, both these customers that you talk about, in the recent commentary that they have given, they are saying that inventories at the dealerships are practically zero, and that even today, for most of the machines they make, there's a wait list of 3 to 6 months. So clearly, they are seeing a very robust few years moving forward, you know.
You know, quickly before we let you go, Gurdeep, if you could tell us, so the last few years you've been growing your revenue at 16% Your EBITDA has actually grown much faster. 22% is the margins that you've reported. Is this a sustainable level? What kind of growth can we foresee in terms of margins going forward? And at what point would you want to, deploy some capex?
Absolutely. In fact, very frankly, the last 6 years, the top line has grown 12.1% CAGR. And you're right, the EBITDA has grown 30% CAGR in this period, and the PAT has grown 40% CAGR. And like I said, we are a very cash-rich company. And on the flip side, our spend on capex is very low. It's only 3% of our top line. So we are planning to do capex of 45 crores this year. What happens is that our depreciation is about 40 crores, and about 50% of the depreciation we use as replacement capex, which really adds another 5 to 7% capacity. And then for every $1 of new business that we get, 16 cents is a spend on machinery. Our capex is also low because this does not include land and building. And we actually are, even the 6th factory that we are setting up in India, we've already taken it on rent and on lease. And this 6th factory will be enough for the capacity required for the next 2 years moving forward for us.
All right, Gurdeep, we got it. Thank you very much for joining us. We will leave it at that today. And, when the company lists, we hope to get a little bit more details from you in terms of, what the business's growth could look like going forward. It's time for a short break, but there's lots more market action when we come back. Into trading hour for the market, we're now around 40 points higher, so we have moved off the day's low. The Nifty Bank has also moved off the lows right now. It's seeing a cut of just around 0.2%. So that's what's happening with the markets. But if you take a look at the sectors, it is the metal space which is doing well. A lot of the real estate stocks also holding up quite nicely today. But let's get you some interesting market opinion. We spoke with Gary Schlossberg, global strategist at Wells Fargo Investment Institute. So listen into what he has to say on China and the Indian market performance from a global standpoint.
The move away from a zero COVID policy is somewhat nuanced. There are some risks along with that. China's healthcare system doesn't really have the capacity to deal with a big ramp up in infections if that is the case as they relax that zero COVID policy. There is also the question of how effective the vaccines are in China. Valuations are certainly an issue, but the growth outlook, even though we do expect to see it losing some momentum over the next 12 months, we continue to find India an attractive, relatively attractive market within the emerging market space.
All right, India continue to remain relatively attractive is what Gary Schlossberg is saying. We take a short break, come back, we focus on the markets on the other side as well. It's meandered around that 18,650 mark. We do have the mid-caps which are doing extremely well. And while we were talking about Oberoi Realty, just take a look at the other real estate stocks. Godrej Properties too has moved to the high point of trade as we speak. And the mid-cap index itself at an index level is at the highs of the day. The other couple of stocks which are doing well, we have Bata from the broader markets, which has picked up from the lows. So currently sitting with a mild gain of just sub 1%, but it is significantly off lows. And from the frontline end of things, we had the FMCG stocks do extremely well yesterday, and today it's being followed by the paint stocks. So remember, crude is around that $83, $84 per barrel mark off highs, and we are seeing some stability in the rupee as well. That does well for all these paint companies, and Asian Paints understandably at the high point of trade. We wrap up on this edition of Trading Hour on that note. Stay tuned. Halftime report comes up next.